I'm ready. So my time starts now.
Yes.
Good morning, and thank you for the opportunity to provide this oral submission. My name is Don Richards, and I'm the National Spokesperson for Positive Money in New Zealand. By changing the way we issue our money, we can make a significant improvement to the lives of Kiwis. Currently, the Reserve Bank issues less than 3% of our money supply in the form of notes and coins. Private overseas banks, create the balance, approximately 97% of that, by way of loans and mortgages. And that money is used for internet banking transactions and our digital currency. Now, the Bank of England issued a paper in 2014 called Money Creation in the Modern Economy, and it stated the reality of how money is created differs significantly from some economic textbooks. Rather than banks receiving money when householders invest funds and then lending them out, bank lending actually creates the deposit. So said another way, banks create money out of thin air, or ex nihilo, which is Latin for from nothing. And our Reserve Bank confirms that the Reserve Bank follows the same process as that in the UK. Now, our written submission outlines other issues with the current system. The first and most tangible one is once the loan is repaid, that money disappears from the economy. It is created from nothing, so it returns to nothing. For our money supply to grow, more people must get in debt than get out of debt. And that is unsustainable because that means they then have to make significant decisions on paying essential items or funding debt. Now, housing inflation is also a major problem. Under the current systems, banks have a profit imperative. So they put money where they can make the most money or profit at the least risk, which is land and housing. The availability of an almost endless supply of credit pumps up the cost of housing, making it unaffordable for most Kiwis. Conversely, banks do not put much money into the productive economy because it is riskier and the return is lower, which starves our productive sector of much needed capital. Governments and local authorities also borrow money for infrastructure projects when they do not need to. With the Reserve Bank issuing our digital currency to government, that money can be used to construct our roads, schools, hospitals, saving the government billions of dollars in capital and interest payments. Money could then be directed towards areas such as mental health, child poverty, or tax cuts. Now, the amount of money being created would be strictly controlled by an independent body outside of government called the Monetary Policy Committee. That body would assess the amount of money required by the economy and would authorise the Reserve Bank to issue that amount and no more. The government would then decide where to allocate those funds, similar to how it does with our tax revenue. Now, some say this would be inflationary, but under the current system, banks create about $40 billion a year, pumping that into housing, and the CPI stays below 3%. Using central bank money has been done before, in 1936 by the first Labor government, when the Reserve Bank injected millions of pounds into the economy to finance the construction of tens of thousands of state houses. The Central Bank of Canada did that successfully for over 40 years, funding infrastructure projects such as the St. Lawrence Seaway. And in response to the dislocation caused by the coronavirus, China's central bank will inject $275 billion into the markets to ensure that they have enough cash. That is a great example of a central bank helping out in times of need without the requirement to take on more debt. Now, we're not alone in calling for central banks to issue our digital currency. The central banks of Canada, England, Japan, Sweden, Switzerland, the European Central Bank, together with the Bank of International Settlements, is investigating the case for central bank created digital currency. So in closing, over 97% of our money is created by private banks as debt. This is a political choice, not a technical necessity. We submit that this Parliament owes the people of New Zealand an urgent review of our money system, and this must include an answer to the question, who should create and control our money supply? Thank you.
Thank you very much. Committee members, I think Greg had a question.
Yes, what's the difference between what you're proposing and quantitative easing?
Well, quantitative easing, it gives money to the banks and then the banks lend it out as debt. What we're proposing is cut out the middleman, do not issue it as debt, provide it for infrastructure projects, and then that money gets circulated into the economy. We do talk sometimes about quantitative easing for the people, which is different, and that means providing the money to the people without giving it to the banks to loan out the debt.
So who's, with quantitative easing, whose balance sheet does that sit on, and where would this sit on a balance sheet, this money that you're talking about creating?
Well, about quantitative easing, the money sits on the banks, the private banks' balance sheet. With the sovereign money, it would sit on the Treasury or the Reserve Bank's balance sheet.
As a debt?
Yes.
Or as an asset?
Well, it would be a double entry. So the money would be created by Treasury and handed to government to then allocate in the same way as the tax money. So it gets introduced into the economy that way.
But presumably it's got to sit somewhere as a debt and somewhere as an asset.
No.
It does sit as a debt, but it doesn't have to be repaid. It'd be represented by a zero coupon interest bond.
Yeah, Duncan?
So that's the creation of money question. You seem in your analysis to be saying that banks shouldn't be able to create money in the way that they have. Yeah, is that correct? Am I right?
Yes, that's right.
Okay. So that's a bit tricky though, isn't it? Because ever since the Italians realised that if you held gold, you could give credit out for more gold than you held, that has been banking practice. That's the very principle on which banks work, is that they create money on, or they create credit on the back of holding less reserves than the obligations that they create in this kind of circular fashion. So are you proposing that we bring a halt to the ability of banks to lend out more in loans than reserves that they hold?
Yes, that's right. It's called 100% reserve. And cast your mind back, I used to do property settlements for lawyers. And back in the 1960s and 70s, the money for housing came from a finite pool from the trust accounts of lawyers or from State Advisors Corporation. And it was only the money that was there that was available to be lent out to housing. So that created a
That's not quite accurate, because as soon as, you know, I saved up enough money for a house, I purchased it from you, you took my £7,000, put it in the bank would immediately lend that out on a mortgage. Mortgages have been around forever. The bank would immediately lend that out on a mortgage to someone else.
well,
Who
actually,
only had £1,000 and borrowed £6,000.
actually, if you look at the statistics, bank lending constituted 10% of the mortgage lending in the 1960s and 70s, and it now constitutes 90%. So we had the trustee savings banks, and they lent a wee bit of money, but the vast majority of mortgage funding was not issued by banks
So
until
it would
the,
still issued in the same way, because it was issued, in fact, a lot of lending came from building societies, which operated in exactly the same way in the mortgage market as a bank did and created money in the same way. So what you seem to be saying would in fact contract our money supply wildly and and yes, it would drive house prices down catastrophically because credit would be pretty much unavailable.
well, no, the credit would be injected into the economy via the Reserve Bank for infrastructure projects and the like. So currently banks issue $40 billion a year. We're proposing that the Reserve Bank, through Treasury, issue between $20 and $30 billion to the government. And so that money is then kept in circulation and it does not disappear once it's repaid. So if you say that the banks then lend that money out, they don't. If the principal is repaid, it is destroyed. It cannot be lent out. New money has to be created.
So I've got one more question from Raymond, and then we'll need to call it to an end because the time is
Sure.
up. So.
From page 17 of the submission, digital currency and its possible impact on the market, such as inflation. Any thoughts in that space?
Yeah, so long as there's capacity in the economy for that money to be issued, then there's not a problem. Currently, our digital currency is issued by the private banks, and they're flooding our economy with money, but the CPI remains under 2%. So if it is put into areas where there is capacity, then there would be no issue, no inflation.
Okay. And we're over time on that.
Sorry.
There you are. Look, thank you for coming in this morning and for answering our questions.
Well, thank you very much for having us. It's much
thank you.
appreciated.
Okay, thank you.
Thank you. Interesting concept.
Yeah, it is. Okay, we'll need to clear the room. Thank you.